Let me ask you something. What if the most dangerous moment in this crypto market isn't a crash? What if the most dangerous moment is the one right before the recovery, when fear is loudest, confusion is deepest, and 99% of people are positioned completely wrong? Because right now, on May 14th, 2026, Bitcoin is sitting just below $80,000. It broke through that level for the first time since early May, down more than 2% on the week. ETF outflows hit $635 million in a single day yesterday, one of the largest single-day redemptions in months. Institutions are pulling back. Retail sentiment is buried. CPI just came in at 3.8%, the highest reading since 2023, wiping rate cut hopes off the calendar entirely. And on top of all of that, today is Jerome Powell's final day as Fed chair. Let that sink in for a second. Everything looks broken. But here's the thing that's keeping seasoned traders up at night. Markets that look this broken at exactly this kind of moment have produced some of the most violent, most unexpected reversals in financial history. Tonight, we are breaking down the V-shaped recovery theory, why it's developing beneath all this chaos, what the data is quietly screaming, and why millions of people could completely miss the next move before they even understand it's happening. Stay locked in, because this one connects every dot. Everything discussed on the wealth continuum is for educational and informational purposes only. Nothing here is financial advice. Crypto markets are highly volatile and unpredictable. Always do your own research and consult a licensed financial professional before making any investment decisions. Past patterns do not guarantee future outcomes. Let's start with exactly where we are today, because the picture is more nuanced than the headlines suggest. Bitcoin opened this week at $81,520. It pushed toward $82,000 on May 11th and got rejected for the fourth consecutive time in 2 weeks. The 200-day moving average, sitting at $82,228, acted like a wall. Every attempt to push through it failed, and when resistance holds that many times, it tends to eventually destroy the buyer's conviction. That's exactly what happened. By May 14th, price had broken below $80,000, a floor that had held through all of April and most of early May. And just yesterday, on May 13th, spot Bitcoin ETFs recorded $635 million in net outflows. BlackRock's iShares Bitcoin Trust, IBIT alone, shed $285 million in a single session. Total Bitcoin ETF assets still stand above $105 billion, but the directional momentum shifted hard. So the question every trader is asking right now is simple. Is this the beginning of a real breakdown, or is this the last shakeout before a violent recovery? Because here's what's strange. Despite all of this selling pressure, despite the ETF outflows, the macro headwinds, the Powell transition, Bitcoin hasn't collapsed the way the bears expected. It's down, it's bruised, but it isn't broken. And that matters more than most people are willing to admit right now. Comment below if you've been watching Bitcoin's price action this week and felt genuinely confused about which direction it's headed. Because I want to know how many of you are seeing the same contradictions I'm seeing. Because confusion at key turning points isn't a problem. It's actually a signal. Markets don't hand out obvious setups. If the move was obvious, it would already be gone. Stay with me, because what comes next completely reframes this entire situation. If this is the first time you found the Wealth Continuum, hit subscribe right now. We break down the hidden macro forces moving crypto before the mainstream catches on. You don't want to find this channel after the move already happened. Let's talk about what a V-shaped recovery actually is, and because it's not just a shape on a chart, it's a psychological event. The market drops hard. Fear dominates. Every analyst on social media starts confidently predicting the bottom is still far away. Short positions pile up. Retail investors freeze or sell. Then suddenly, without warning, without a clear catalyst that anyone saw coming, the market reverses with explosive velocity. Not slowly, not gradually, violently. And the reason it happens so fast is because of positioning. When too many traders bet against the market simultaneously, the market runs out of sellers. Then even modest buying pressure starts to cascade. Shorts get squeezed. Algorithms detect the reversal. Momentum flips, volume spikes, price moves before most people can process what's happening. We saw this in the COVID crash of 2020. Global markets collapsed in weeks. Sentiment was apocalyptic. Then, central banks flooded the system with liquidity, and what followed was one of the most aggressive recoveries in modern financial history. Crypto didn't just recover, it went parabolic for the next year and a half. We saw a version of it after the banking panic in March of 2023. We saw it after ETF-related fear in early 2024. And Bitcoin's own history is littered with V-shaped reversals that most people missed. Because the news was too negative, the fear was too real, and the certainty of continued downside felt too logical to ignore. Here's the brutal truth about V-shaped recoveries. They are psychologically impossible for most people to buy. Because the moment when risk is actually at its most favorable, when the price is lowest, when sellers are exhausted, when the structural setup is most attractive. That's also the exact moment when the emotional pain is at its highest. Your screen is red. Your friends are panic selling. The news is terrible. Every instinct screams, wait. And so you wait, and you wait. And by the time the recovery is obvious, you've missed 60% of the move. Hit, like if you've been in that exact situation before, watched a recovery happen and thought, why didn't I buy that? Because understanding why that happens is the most valuable education in crypto. But here's what they're not telling you about the current setup. This isn't just about price psychology. There are structural forces beneath this market that the average retail investor simply isn't tracking, and those forces may be building towards something significant. Let's talk about the macro backdrop, because this is where most content creators completely miss the story. Everyone is focused on CPI at 3.8%. Everyone is panicking about the fact that rate cuts are now off the table for 2026. And yes, higher for longer rates are a headwind for risk assets. That's real. But here's what they're not telling you. The same pressure that's killing rate cut expectations is also building a macro contradiction that markets are going to have to resolve. On one side, inflation is sticky, rates stay elevated, financial conditions tighten, risk assets suffer. On the other side, the US government is sitting on a mountain of debt that needs to be refinanced. Economic growth is decelerating, and the political pressure on the new Federal Reserve leadership, Kevin Warsh takes over from Powell starting today, is enormous. Warsh's first FOMC meeting isn't until June, which means there is now a window, right now, of genuine leadership uncertainty at the world's most powerful central bank. Markets historically sell risk assets during Fed chair transitions, and this week delivered exactly that. But here's the curiosity loop that should be living rent-free in your head right now. What happens when the transition uncertainty resolves? What happens when the new Fed chair makes his first statement, signals his first policy tone, and markets get clarity on the direction of monetary policy for the next phase of the cycle? Historically, clarity, even unwelcome clarity, tends to spark relief rallies. And if that clarity arrives alongside any hint of future accommodation, even in tone, even in language, the reaction in a market this short, this fearful, this positioned for bad news, could be explosive. You need to understand this before I show you what's next. Because the liquidity story doesn't end with the Federal Reserve. Global central banks are under synchronized pressure right now. Debt markets are fragile across Europe and Asia. Several major economies are quietly moving toward looser conditions. And Bitcoin, which behaves less like a tech stock and more like a high volatility liquidity sponge, has historically amplified liquidity expansions in both directions. When liquidity contracts, Bitcoin bleeds. When liquidity expands, Bitcoin moves faster than almost any other asset on Earth. The question isn't whether liquidity eventually shifts. It almost certainly will. The question is whether you're positioned before it does or after. What do you think? Is the Fed transition this week a major bearish catalyst or actually a potential clearing event? Drop your answer in the comments. I want to see how the community is reading this. Now let's go beneath the price chart, because on-chain data tells a different story than the headlines. This is where it gets really interesting. While spot markets have been soft and ETF flows turn negative, on-chain analysts have been tracking something unusual. Large wallet accumulation, what the industry calls whale activity, has continued during fear spikes. These aren't retail traders buying the dip emotionally. These are strategic, deliberate accumulations from wallets with significant holdings. And here's the pattern that matters. Bitcoin's all-time high was $122,000 in July 2025. We're now sitting near $79,000, roughly 35% below that peak. During that entire drawdown period, exchange reserves have been consistently declining. Long-term holders have been largely stationary. Coins are moving off exchanges into cold storage rather than towards selling. That's absorption. Someone, or multiple someones, is quietly buying the fear. Now add the supply side. BlackRock's IBIT alone holds approximately 809,870 Bitcoin, roughly 7% of the total supply. Total Bitcoin ETF assets stand at over $105 billion. And with Bitcoin's fixed issuance after the April 2024 halving, new supply entering the market is structurally limited. So think about what that actually means. You have declining exchange reserves, you have long-term holders not selling, you have ETFs absorbing supply, you have post-halving issuance at its lowest ever, and you have a price that's already down 30+% from its all-time high. What happens when demand turns? Not if, when. Because demand cycles in Bitcoin have never permanently ended. Every cycle in Bitcoin's 16-year history has eventually seen demand return. What happens when institutional buyers flip from reduce exposure to buy the dip against a backdrop of tightening supply? The answer, historically, is a supply shock. And supply shocks in crypto don't announce themselves. They don't give you time to prepare. They show up as vertical candles on a chart while you're sitting there waiting for a better entry that never comes. Stay with me, because the next section explains why the derivatives market may actually be the trigger for everything. Here's a question that should be haunting you right now. If $635 million left Bitcoin ETFs in a single day yesterday, why didn't the price collapse? Think about that for a second. $635 million in one day. And Bitcoin is sitting at $79,000. Not $60,000, not $50,000, $79,000. When ETFs record outflows, the mechanics are straightforward. Authorized participants sell Bitcoin on open exchanges to return capital to redemptions. That's direct selling pressure on the spot market. And yet, the market absorbed it. Here's what that tells you. Either there are buyers absorbing every ETF sell order in the spot market, which points to significant demand at current levels, or the selling has been so well telegraphed that sophisticated players have already positioned to capture the liquidity. Either way, the market's refusal to collapse under genuine selling pressure is a sign of underlying structural strength that the bear case narrative simply doesn't account for. Cumulative net inflows to Bitcoin spot ETFs since their launch still stand at $59 billion. The total ETF ecosystem holds over $105 billion in assets. These aren't speculative retail products anymore. They are institutional infrastructure. And institutional infrastructure doesn't get abandoned in a Tuesday correction. It gets accumulated on dips. If you've been watching for a while and this finally made the picture click, do me a favor and drop the word absorbed in the comments, because understanding what price absorption actually signals is one of the most underrated edges in crypto investing. Now, here's where the real danger lives, and I mean danger for the bears. Let's walk through a scenario. Bitcoin continues to drift lower over the next few days. Maybe it tests $75,800, the major support zone from the April breakout. Fear intensifies. Social media is full of "I told you so" posts. Short interest builds aggressively. Leveraged positions accumulate on the downside. And then something shifts. Maybe Warsh makes a dovish statement at his June FOMC meeting. Maybe ETF flows reverse for 3 consecutive days. Maybe a major on-chain metric crosses a threshold that algorithmic trading systems are watching. Bitcoin reclaims $80,000. Suddenly, shorts feel pressure. Initial liquidations hit. Momentum algorithms detect the signal. They start buying. More shorts get squeezed. Volume spikes. Market makers are forced to hedge their exposure by buying spot. Retail sees the green candles and FOMO creeps back in. Within 24 to 48 hours, Bitcoin could be back above $82,000. And everyone who was waiting for the obvious bottom is chasing a market that already moved. This is not speculation. This is a documented, repeatable pattern in crypto. Derivatives, liquidation cascades have been responsible for some of the most violent single-day moves in Bitcoin's history. And right now, with positioning this one-sided, with sentiment this bearish, with this many people convinced that lower prices are guaranteed, the market is sitting on a coiled spring. Subscribe if you want to see the full breakdown of how crypto derivatives leverage cascades actually work. Because understanding that mechanism is what separates traders who anticipate the move from traders who watch it happen. Let's zoom out for a second. 2026 gave Bitcoin its worst first quarter since 2018. That's not a small detail. That's a historic data point. In 2018, after Bitcoin's first quarter collapse from nearly $20,000, the market entered a brutal multi-month bear market. That's the bad analogy. But here's the other analogy. After 2018's worst quarter, Bitcoin bottomed, and then over the next 2 years, it built the foundation for a cycle that eventually took it past $68,000 for the first time. After the second quarter of 2022, another historically bad period, Bitcoin spent months consolidating before launching the recovery cycle that eventually produced the all-time high above $122,000 in July of 2025. The pattern isn't guaranteed, but the setup isn't without precedent either. Historically, Bitcoin's worst quarters have been followed, not immediately, but eventually, by some of its most productive recovery periods. And here's the question that forces you to think honestly. If you knew today that Bitcoin was going to hit $100,000 again before the end of 2026, would the current price look like a crisis or an opportunity? The way you answer that question reveals more about your investing psychology than any analysis ever could. This is where it gets really concerning. Not for the bulls, but for anyone who's waiting for permission to have conviction. Because the market doesn't give you permission. It gives you price action. And by the time price action is giving you the comfortable signal, the cheap entry is already gone. Here's the part that most traditional crypto analysts are completely underestimating. This cycle is different from 2018, from 2020, from 2022. Not because of Bitcoin's fundamentals. Those have actually improved dramatically. It's different because of who is now trading it and how fast they can move. Major hedge funds and quantitative trading firms now run machine learning systems that monitor liquidity conditions, derivatives positioning, order flow, volatility structure, macro correlations, and on-chain signals simultaneously, continuously, and faster than any human team can react. These systems don't feel fear. They don't get impatient. They don't panic sell. They wait for mathematical thresholds to be crossed, and then they execute with precision and speed that is genuinely difficult to conceptualize. Here's what that means in practice. When momentum conditions flip, when on-chain signals align, when derivatives liquidations begin cascading, when price crosses a key level, thousands of algorithmic systems can detect that simultaneously. They buy. The buying creates momentum. Other systems detect the momentum. They buy. Retail notices the green candles. FOMO activates. More buying. The entire process can go from nothing is happening to Bitcoin is up 15% in 48 hours, before most retail investors have even processed the initial move. This reflexivity, where price action itself becomes the catalyst for more price action, is what makes V-shaped recoveries in this era of crypto trading so violent, so fast, and so emotionally devastating for anyone who wasn't positioned ahead of them. The market now punishes hesitation faster than it ever has before. Share this with someone who needs to understand why this crypto cycle is fundamentally different from every previous one, because the speed at which things can move now is something most people are dangerously unprepared for. Now let me be completely straight with you, because this channel doesn't do false hope. The V-shaped recovery theory is not a guarantee. It is a framework for understanding a set of conditions that have historically preceded explosive recoveries. That's it. The real risks are significant. If CPI continues rising and the Fed under Warsh becomes more hawkish than expected at the June meeting, not less, liquidity conditions could tighten further and crush risk assets across the board. If the next major support level at $75,800 fails decisively and with high volume, the market structure shifts bearish in a way that could take months to repair. If geopolitical tensions, particularly in the Middle East, where the situation remains highly unstable, escalate in a way that drives global risk-off sentiment, Bitcoin's role as a high liquidity, 24/7 tradable asset makes it one of the first things institutions sell. And if the regulatory environment shifts unexpectedly, the Clarity Act in the Senate is still being negotiated with over 100 proposed amendments, the uncertainty premium in crypto could rise sharply. Any one of these scenarios could override the bullish structural setup entirely. Smart money doesn't pick a narrative and refuse to update. Smart money holds a thesis loosely and watches the data. If the data changes, the thesis changes. That is what separates investors who survive multiple cycles from those who blow up their portfolios chasing a story that already stopped being true. What's your biggest risk factor for crypto right now? Macro, regulation, or something else entirely? Tell me in the comments. I read these, and the best answers often shape the next video. Let's end with the most important part. Everything we've discussed, the on-chain data, the derivatives positioning, the liquidity cycles, the AI-driven trading systems, none of it matters if you can't manage the psychological dimension of what's happening. V-shaped recoveries, by definition, happen when psychology is at its worst. The news cycle is negative. Everyone you trust is cautious. Your own account is in the red. And the idea of adding exposure, let alone making a decisive move, feels genuinely irrational. That's the trap. Because the market doesn't recover when the news gets good. The market recovers before the news gets good, often weeks or months before the average person feels comfortable. And by the time the news is good, by the time the headlines are validating, by the time your group chat is excited again, the risk reward has completely changed. The cheap entries are gone. The volatility premium has been extracted by whoever had the nerve to position during the chaos. Markets have always transferred wealth from the emotionally reactive to the structurally prepared. Not because the structurally prepared are smarter, but because they built a framework in advance, and they held it when it was uncomfortable. Right now, the question isn't whether Bitcoin will recover. Over every meaningful time horizon in its 16-year history, it has. The question is whether you'll be positioned for it, or whether you'll watch it happen and add it to the long list of moves you almost made. That question is worth sitting with tonight. So let's bring it all together. Bitcoin sitting near $79,000 today on May 14th, 2026. Broke below $80,000 for the first time since early May. $635 million in ETF outflows just yesterday. CPI at 3.8%. The Fed chair transition happening in real time. Bears feeling increasingly confident. And beneath all of that, declining exchange reserves, continued whale accumulation, a post-halving supply structure that has never been tighter, algorithmic trading systems primed to amplify whatever direction momentum breaks, and a historical pattern of V-shaped recoveries emerging from exactly this kind of maximum confusion moment. Is this the setup for the most significant recovery of the current cycle? Or is the market genuinely about to fall further and test the structural support zones that would change this analysis completely? That's the honest answer. Nobody knows with certainty, but the data is worth watching very closely right now. If you've been watching the wealth continuum for a while and this breakdown finally made the full picture click for you, do me a favor. Drop the word absorbed in the comments. That one word tells me you understand the most critical concept from tonight's breakdown. If you think Bitcoin holds here and we're watching the setup for a V-shaped recovery, comment bullish structure. If you think we're heading lower before any recovery and the bear case still has legs, comment testing lows. And one more thing, tell me in the comments what you want the next video to cover. Is it the Fed chair transition and what Warsh means for crypto policy long term? The altcoin market and which assets show the strongest structural setups right now? Or a deep dive into how derivatives liquidation cascades actually work and how to position around them? Your comment shapes this channel, so use it. Hit subscribe if you want macro breakdowns, hidden liquidity analysis, and the structural forces moving crypto before the crowd catches on. We do this differently here. No hype, no noise, just the framework. And share this video with someone in your circle who is either panicking right now or waiting on the sidelines trying to time the perfect entry. They need to see this before the market moves without them. Because in this market, as always, the biggest moves happen before the crowd understands what's happening. I'll see you in the next one.